Today we're launching our last report for 2018, our November bi-monthly report. Despite the turmoil being experienced on financial markets and an escalation in Brexit negotiation over recent weeks, the autumn season in the Irish commercial property market was every bit as busy as had been anticipated, with strong momentum witnessed across all sectors during the months of September and October. With Halloween now behind us and Christmas looming, the focus will shift over the coming weeks to getting transactions in all sectors completed before year end, with very little new product likely to be launched to the market during the next 2-month period. Office take-up in Dublin reached more than 56,000 square metres in Q3. Although somewhat less than the strong volumes experienced in the first and second quarter, it brings total take-up in the first 9 months of the year to more than 220,000 square metres. In addition, there's a strong volume of stock reserved and due to complete in either the fourth quarter or early 2019. Interestingly, more than 1/3 of the office stock let in Dublin in the year to date comprised pre-lettings. As we approach 2019, the volume of outstanding requirements for office accommodation in the capital remains particularly healthy at over 323,000 square metres, with demand emanating from a range of different sectors. Although several of these requirements are from the technology occupiers, it is interesting to note that the Irish state also have several active requirements for modern office accommodation at present, including 3 relatively large mandates. More than 12% of leasing activity in the Dublin market in the first 9 months of 2018 emanated from flexible occupiers, as the demand for co-working and flex space continues to increase in line with the trend being experienced in other jurisdictions. This concept is proving particularly attractive in Dublin, where many occupiers need flexibility until such time as they're clear on their longer-term size requirements. While this is having relatively no impact on larger transactions in the market, which are continuing regardless, it is creating additional competitive pressure for landlords who are marketing small to medium-sized floors and buildings in the market. As we approach year-end, the Irish retail market continues to buck the European trend, with Ireland's strong economic backdrop supportive of the retail sector of the economy, as is evident from various measures such as retail sales activity, footfall numbers and consumer sentiment. Indeed, the latest Visa Irish Consumer Spending Index for September saw the 19th consecutive month of expansion in retail sales in Ireland being recorded, with expenditure up 1.5% year on year. Against this backdrop, the retail property market continues to perform well, with strong appetite for any well-located schemes or retail units that are brought to the market, and with particularly strong demand from the food and beverage sector. Encouragingly, demand for good secondary and suburban locations has been improving of late, and indeed our latest high street vacancy counts around the country have seen occupancy improving in several locations over the last 12-month period. Activity in the retail property market is likely to slow a little over the next 2 months, as retailers understandably focus attention on their core business during the traditional Christmas trading period. The next couple of weeks will be busy for retailers, with high streets, shopping centres and retail parks expected to trade well in the run-up to Black Friday, Cyber Monday and beyond. In the background, huge efforts will be underway to progress the many retail transactions that have been languishing in legals for some time now, with a view to getting as many of these deals as possible across the line before year end. Following a relatively slow start to the year and a significant number of transactions completed in the industrial and logistics sector in Dublin during the third quarter of 2018, bringing total take-up in the first 9 months of the year to more than 210,000 square metres, which is 24% higher than the volume achieved in the first 9 months of 2017. This demonstrates the impact that new supply is now starting to have in this sector of the market. There's been a notable increase in demand for new buildings of late, although the extent to which this is attributable to the intensification of Brexit negotiation does remain to be seen. Several buildings are now being pre-let prior to practical completion. Such is the demand for new industrial stock. The average vacancy rate in 25 of the most modern industrial and logistics parks in Dublin is currently 8.23%. Prime rents in this sector remain stable at approximately €106 per square metre, but are expected to reach approximately €110 per square metre by year end. This, in turn, is piquing the interest of investors who continue to seek out good industrial investment opportunities on the back of the rental growth potential. As a result, we've seen some hardening of yields in this sector over recent months. Total returns in the Irish commercial property market increased by 6.9% in the first 3 quarters of the year, according to MSCI. This is an impressive return, which continues to encourage a range of domestic and international investors to invest in what is now regarded as a stable and core market. Total spend for the first 9 months of 2018 surprised on the upside, boosted by a number of forward funding transactions, including several in the build-to-rent space. In total, more than €2.67 billion was invested in Irish investment assets in the 9-month period. With several large transactions in legals at present, it is now looking increasingly likely that total spend for the year as a whole could exceed €3.5 billion. Encouragingly, there is also good visibility on a healthy pipeline of stock for 2019, particularly in the office sector, which will satisfy investor appetite. As we approach year-end, there will be a focus on getting transactions signed and also on preparing 2019 sales campaigns. Demand for core assets remains very healthy, and these assets continue to be well bid. However, unless assets are competitively priced and/or there are obvious opportunities to add value, the liquidity for secondary assets is somewhat weaker by comparison. Yields in all sectors remain relatively stable at this juncture, although there is potential for some further yield hardening in due course for prime offices, prime multifamily build-to-rent, prime industrial, and also in the hotel sector. There was a notable increase in both the volume and value of development land traded in the Irish market during 2018, a trend that has been clearly evident over recent months as some large development transactions completed and indeed some new sizable assets were brought to the market. In total, 105 development land transactions totalling almost €940 million between them signed to the end of September, which is considerably more than the annual average spent on development land each year since 2014. One of the most significant announcements in the development sector in the last 2 months was the establishment by the Irish Government of a new land development agency. The agency's remit is primarily to focus on the better utilisation of public land and to enter joint ventures with developers on some larger sites, with a view to delivering 150,000 new homes over the next 20 years. While the agency is unlikely to deliver significant housing output in the short to medium term, the concept is sound, and it is to be welcomed as part of a multifaceted approach to Ireland's housing crisis. We continue to see strong appetite for sites capable of supporting the development of build-to-rent and co-living concepts, with particularly strong demand for sites in established residential locations with good transport links. The pool of buyers has deepened quite a bit in recent months, and we now have traditional house builders that are predominantly involved in the development of housing residential stock to sell, also quite active in the market, which is encouraging. In the hotel and licensed market, only 12 hotel transactions totalling almost €263 million between them and one investment sale totalling €17.5 million transacted in the Irish market during the first 9 months of the year. However, the recent completion of Project Trident, the TIFCO portfolio, which included 17 trading hotels and also some development assets, as well as Tetrarch's acquisition of the former Deer Park Hotel in Howth in North County Dublin, and the investment sale of the Premier Suites Apart Hotel in Ballsbridge. Those 3 transactions have provided a very significant boost to transactional activity in the hotel sector in the last couple of weeks alone. The latter transaction, the Premier Suites one, achieved a yield of approximately 5%, demonstrating the strength of investor appetite for hotel investment opportunities in the Irish market at present. There's still considerable activity underway behind the scenes, but it remains to be seen how many of the several hotels that are currently in negotiations and in legals will conclude before year end. Negotiations are continuing on several large profile sales, including the K Club, Druids Glen, the Central Hotel in Dublin city centre and the Plaza in Tala, while terms are now reportedly agreed on the Heritage Hotel in Killinard in County Laois and the Castle Oaks Hotel in County Limerick. The most recent statistics from the Central Statistics Office show that 8.2 million visitors made trips to Ireland during the first 9 months of 2018, an increase of 7.1% on the same period last year, with visitor numbers in September alone up 2.9% year on year, which has boosted hotel performance. However, the hotel industry was understandably disappointed with the government's decision in the most recent budget to increase the 9% rate of VAT that had applied to the hospitality sector since 2011 to its previous rate of 13.5%, which will be effective from the 1st of January 2019. It remains to be seen to what extent this move will be negative for hotel performance over the next 12 months, although it is clear that provincial hotels will be more exposed. According to our research, over 900 new hotel bedrooms have opened for trade in Dublin during 2018, with the most recent being the 40-bedroom boutique hotel, the Devlin, which has just opened in Ranelagh in Dublin 6. The Dublin pub market has been relatively quiet during the year, with only 17 properties totalling more than 30 million between them having traded in the first 9 months of 2018. However, the quantum of pubs changing hands is low. The average sale price has increased to 1.77 million, which is encouraging and reflects the improved trading conditions being experienced in this trade. Finally, to the Cork market, September and October saw continued momentum in activity in the commercial property market in Cork, with several transactions having completed in recent months and also strong interest in evidence for the various assets launched during the autumn season. Activity has been particularly encouraging in the office occupier market, buoyed by recent job announcements from occupiers such as Vox Pro. Force Point recently committed to 1,487 square metres at 86 South Mall, joining PwC, meaning that this office building, which is due for completion in the first quarter of next year, has now been fully pre-let. This, in turn, is encouraging developers to commence construction on additional buildings in the city centre of Cork. Block B at the Navigation Square scheme, which extends to over 9,300 square metres, commenced construction in September, and planning was recently granted for over 23,000 square metres at the Penrose Dock scheme in the city. The recent letting of over 1,600 square metres to flexible office provider Glandor at City Quarter on Laps Quay will see 300 additional flexible office spaces being available in the city in due course. This is an interesting development considering the extent to which co-working and flexible concepts are evolving in other cities. Meanwhile, in the hotel sector, there is much excitement about the imminent opening before Christmas of the new 4-star Maldron Hotel on South Mall. When complete, this property will be Cork's second largest hotel. The Project Lee portfolio loan sale, which included some prime Cork assets, has now gone sale agreed for a reported €300 million. Meanwhile, contracts have now exchanged on the sale and leaseback of the Quest office building in Citygate in Mahon for more than 21 million, while the Webworks office building in Eglinton Street in Cork has also recently gone sale agreed. Considering the dearth of new housing supply in the Cork market, there has been very strong appetite for a prime residential site at Maryborough Ridge in Douglas that CBRE recently launched for sale by way of a licence on behalf of NAMA, guiding in excess of €20 million. The site comprises 2 lots. The first, with planning for 198 residential units, extends to over 20 acres, and the second lot extends to over 24 acres. This land is due to go to best bids on November 8th and looks certain to be the biggest land sale in Cork in 2018. Following what has been a busy autumn season, we expect continued momentum over the next 2 months as another good year for the Irish commercial property market draws to a close. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.